Hello everyone, this is Kathy Lean with our Battle-Tested Swing Trading Strategies webinar. This is hands down one of my favorite webinars because it covers what I think is the most interesting thing about all of our trading techniques and strategies, which is that it basically leverages on a lot of our experience and what we do every single day. Now, before I begin, I'd like to share with you this disclaimer that says trading Forex carries a high level of risk and may not be suitable for all investors. So for those of you that are watching this video on demand, I highly encourage you to pause the screen, read through the disclaimer thoroughly before moving forward. I believe I previously mentioned that we believe that there are three ingredients for the quote-unquote perfect trade. The first one is fundamentals, which we've talked about. The second one is sentiment, technicals, and the third one is sentiment. Now, this session is focused on number 2, which is technicals. So, we looked at previously why technical indicators are so important in the Forex market and how to quote-unquote turn technical indicators into trading strategies. But we looked at it from a very cursory perspective. In the session, we're going to take a much deeper look at how you could turn one of my favorite technical indicators into a trading strategy. So I want to start off with the idea of picking tops and bottoms. Why is picking tops and bottoms so popular? Picking tops and bottoms is popular because we are contrarians. We are contrarians by nature, and we're all contrarians by nature, and we always like to think, to look at things against the crowd. We always like to think, we know something better. We're going to look at things differently from the way everyone else looks at things. So we love to think that, if a currency pair is rallying, it can't possibly go any further. And it is that belief structure that basically, in my opinion, creates an environment where we're always, looking for opportunities to fade a move. But, it's very difficult to fade a move. I mean, basically, it's very difficult to fade a move in a sense that if a currency is rallying, it's usually doing so for a very specific reason. And it's usually doing so because, fundamentals are very strong or fundamentals are very weak or something like that. And so it's very difficult to just, arbitrarily pick a top without a reason to do so. And that is where technicals come into play, and that's where technicals can be so important. And the popularity of quote-unquote picking tops and bottoms is what makes so many technical indicators geared towards mean reversion. And that basically means, returning back to the average, which is another way of looking at picking tops and bottoms, because if it's getting really overstretched, your whole belief is that it's going to get back to average. It's going to come back to the norm. And the three most popular indicators used for picking tops and bottoms are RSI, stochastics, and Bollinger Bands. RSI, stochastics, and Bollinger Bands are very classic picking tops and bottoms indicators. RSI, we looked at this in one of our previous sessions. We talked about how RSI is basically a measure of overbought, oversold using 70-30 as a reference. So if the indicator goes up to 70, that's considered overbought. If it goes below 30, it's considered oversold. Stochastics uses a very similar measure, but on an 80-20 basis. If the indicator goes up to 80, it's considered overbought. If it drops below 20, it's considered oversold. So, those are very classic indicators of, tops and classic measures of tops and bottoms. Now, Bollinger Bands can be used in a whole bunch of different ways. We talked about how to use them initially. Taking a look at, if it's in the 1-2 band, the upside, it's in an uptrend. If it's 1-2 band, the downside, it's in a downtrend. But there's actually a whole variety of ways to use Bollinger Bands that, I hope to share with you today. Now, even though picking tops and bottoms in a market that is so trending can be difficult, it's important to recognize that even hedge funds do it. Even hedge funds are tempted all the time to, look for mean reversion trades. But they mostly do it in the shares market. They mostly do it in stocks, because the stock market is designed for picking tops and bottoms. It's designed for picking tops and bottoms because it's designed for picking tops and bottoms because there is what we call mean reversion. There is true mean reversion in the stock market, where there is overbought and oversold. And also, and that's measured by PE ratios and things like that. It doesn't work as well though for indices, commodities, and currencies, because all of that has a lot of sentiment built into it. So I think it's much trickier, and I think that it's not as accurate. I mean, using the RSI, stochastics, and Bollinger Bands the way they're quote-unquote designed are not as accurate. So in order to pick tops and bottoms, we got to understand that we may be doing different things. You may be picking tops and bottoms in a range-bound environment, or you may be picking tops and bottoms and looking for a major reversal. In a range-bound environment, it's the most common environment. So if you're picking tops and bottoms, most of the time, if you're looking to do it on a day-to-day basis, you're most likely looking to do it in a range-bound environment. In a reversal, it's usually triggered off of a massive price exhaustion and sentiment change. Now, range trading, picking tops and bottoms, is best if you're day trading a currency, whereas reversals are best if you're looking to swing trade a currency. So, if you take a look at this chart of pound dollar, in multiple periods of this, you may be tempted to pick a bottom, particularly in late 2008 and 2009, or even between 2015 and 2016. And there were, of course, bounces, but the bounces were shallow, with the dominant trend being down. So how can you, pick the right bottom? Because at any point in time, you could have picked a bottom that, just ended up being further losses. Whereas between 2009 and 2013, we're in a range-bound environment where picking tops and bottoms can be more effective. So how can you do this? How can you put the odds in your favor and do this more effectively? Well, that's why we love to add on Bollinger Bands, but we love to add on the double Bollinger Bands. In general, we feel that even if you're trading ranges or reversals, they're usually most accurate, in our opinion, in the direction of the trend. But generally speaking, the Bollinger Bands can be very helpful in giving you the tools to pick tops and bottoms. more effectively. And the reason why I've been talking about the Bollinger Bands so much is because I've been using them and trading with them for more than 10 years. And they provide the foundation of my technical analysis and my analysis of, what kind of trends, what kind of environments that currencies may be in. And they're so valuable, in my opinion, with regards to the way that you can use them. They truly provide so much information. Bollinger Bands can be used to determine trend or range. So as a rule of thumb, I like to say, so on this chart what you have is your two sets of Bollinger Bands, which I think I introduced to you previously. The outside lines are the defaults, so 20 period, 2 standard deviation Bollinger Bands. The inside lines are the first standard deviation Bollinger Band. So when you add Bollinger Bands in your charts, you add the outside lines and you add the inside lines. And as a rule of thumb, I like to say that if the currency pair is trading in the 1-2 band in the upside, it is in an uptrend or, quote unquote, the buy zone. If it's trading in the 1-2 band on the downside, if it's trading the lower Bollinger Bands, let me see if I can get a little arrow going here. If it's trading down here, it's in the sell zone. If it's trading up here, it's in the buy zone. The uptrend is dominant here. The downtrend is dominant here. If it's trading between the first standard deviation Bollinger Bands, between the inner lines, then it's in the range trading zone. Let me get rid of this arrow. And you can see that in the dollar-yen chart. You can see that in the euro-dollar chart, which is that when a trend is strong, the currency pair does like to maintain most of its price action between the 1-2 bands. And so it likes to maintain most of its price action between the 1-2 bands. And if the trend is weak, then the bands are kind of narrow and likes to maintain most of its price action between the inner lines. So how do we use Bollinger Bands? So, you may say to me, okay, Kathy, that's kind of interesting, but how do I use the Bollinger Bands for trading? Well, the first thing, quote unquote, thing that we're going to look at is we're going to look at using the Bollinger Bands to, we're going to first look at using the Bollinger Bands to pick tops and bottoms. So using the Bollinger Bands to pick tops and bottoms, instead of just kind of arbitrarily picking a top or bottom, or in the classic way of using the Bollinger Bands, what you would have done is that whenever it touched the upper line of the Bollinger Band, it would be considered overbought. And whenever it's touched the lower lines here, it would be considered oversold. So here you would have picked the right bottom. And maybe you get a little bit of a profit here, and here you would have picked the right bottom. But in this whole scenario here, you have tons and tons of losses. So how can you use the Bollinger Bands to help you trade more effectively? Well, the way you could do that is you would basically use the Bollinger, wait for the currency pair. If you notice, I have some blue arrows painted on this chart. You want to wait for the currency pair to drop below. So it's trading in the uptrend. You want to wait for the currency pair to drop below the first standard deviation Bollinger Band. And when it drops below the first standard deviation Bollinger Band in uptrends, which would be right here, for example, that's when you want to sell. If it's in the downtrend, you watch it sell off, sell off, sell off. You wait for it to roll back above the first standard deviation Bollinger Band, and that's when you want to buy. So instead of arbitrarily picking a bottom here, 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 or here, you would wait for it to show you that it's bottoming out, and then you would buy. So you would buy here, sell here, buy here, sell here, buy here, sell here, and so forth. But let's wrap some more specific rules around this. So we're wrapping some more specific rules around this. The first thing you want to do is you want to look for the currency pair to close below, above or below the first standard deviation Bollinger Band. So in a downtrend, you want to wait for it to close above the first standard deviation Bollinger Band. If it closes in an uptrend, you want to wait for it to close below the first standard deviation Bollinger Band. If it closes below the first standard deviation Bollinger Band, then you sell. And you short at the next candle. So let's look at an example here. So this actually, the examples are reversed here. So let's just look at an uptrend, all right? So I'll change this to above. So here, dollar yen was in previously the downtrend zone, rolled upwards, closed above the first standard deviation Bollinger Band. So it closes above the first standard deviation Bollinger Band, and then you buy. You buy here at 101.10. Your stop is at the swing high or swing low. In this case, since we're buying, it would be swing low or 30 pips in a downtrend below the first standard deviation Bollinger Band. So here we're buying 101.10, stop at 151 because our stop is 30 pips below the first standard deviation Bollinger Band. And basically, our risk is 61 pips. You want to target 1 times risk on half of your position and then move your stop to break even on the remainder of the position and then trail your stop on the remainder of the position. So we risked 61 pips. So our target for the first half of the position is 61 pips. And then we move our stop to break even. And then if it continues to move in favor, you can stay in the trade until it drops back below the first standard deviation Bollinger Band, which means in this case, you'd be in this trade until this point here. The next example is also in a downtrend, the Eurodollar. So it's selling off, selling off, selling off. You short here. So you shorted here, sorry, you went long here at 109.83. This arrow is pointing the wrong place, but you went long at 109.83. Your stop is 30 pips below the Bollinger Band at 108.73. And so you're risking quite a bit in this case because that was a pretty big candle. So you're risking quite a bit, and so you're risking 110 pips. But oftentimes when you do get the bottom in the currency pair, it can truly be a real bottom. So in this case, we basically target 1.1093, and that's basically where we exit half of the position, and you can see that there's still a bit more juice in this trade. So on this chart, I want to show you some other examples. 1 second. So in this example here, this example is a failed example because at a huge spike, but this was when we had the I forgot what it was exactly, but this is the Donald Trump election where Donald Trump won, and it creates a huge amount of volatility in the currency pair. You probably shouldn't be trading anyway on that day, but here you would have sold here. Here you would have sold here. You would definitely hit target 1 here. This you would have bought here. That would have been a failed trade. Here you would have sold here. That would have been a winner as well. Obviously, you're not going to have all winners. There's going to be winners as well as losers, but you want to look for more winners than losers. So that's basically how you could use the Bollinger Bands to pick tops and bottoms using daily charts. Some of you should be asking me, what time frame this is, and so it's a daily chart. But you can also kind of use it on a 4-hour chart, but with slightly different parameters. What you want to do is you basically want to use the same Bollinger Band settings, 20 period, 2 standard deviation, 20 period, 1 standard deviation. but you're using 4-hour charts. So you're using 4-hour charts, and therefore we have a slight addition of a filter. And the slight addition of a filter is that you want to look for two candles to close. You want to look for two candles to close below the first standard deviation Bollinger Band, or above the first standard deviation Bollinger Band, depending upon which side of the trade that you're taking. So, so basically what you want to do is you take a look at the charts, and let's say with the 4-hour chart, we see the currency pair drop below. We see the currency pair drop below the first standard deviation Bollinger Band, where my blue arrow is pointing. At the time, you want to check to see if the last two candles are above the first standard deviation Bollinger Band. So once again, the examples are kind of flipped, but that's fine. So basically, what you want to do is you want to look for two candles to basically be above the first standard deviation Bollinger Band. So basically, here, let me get my arrow back on. You see, in this example here, you see that dollar yen just dropped below the first standard deviation Bollinger Band, and you make sure the past two candles are above it. And the reason why this is important is because you want to filter out this kind of choppiness range noise that can happen on a shorter term basis. And then, and you want to make sure it's by more than 10 pips. This is for a long trade. We reversed the rules for a short trade. So here we shorted and just to go over it again, you watched pound dollar rally, then you watched it drop below the first standard deviation Bollinger Band. It drops below the first standard deviation Bollinger Band. At that time, you check to make sure the last two candles are above the first standard deviation Bollinger Band by at least 10 pips. So we sell at 124.22. 50 pip target, 60 pip stop. So slightly negative risk reward, but that's what we need in order to trade on a shorter term basis. So here you can see our target is you can see that our target is 50 pips. So our target is 123.74, and it gets triggered couple hours later, or maybe a day later, since it's a 4-hour chart. And please remember, exactly what I was saying, which is that because it's a 4-hour chart, we need to be more nimble with our targets, which is why you can even see on the charts that the move isn't very extravagant. So we shorted here. And you can see that our first target was reached, and it's 1-to-1 on a short-term basis. Dollar CAD, here's an example of dollar CAD where we see dollar CAD selling off, selling off, selling off, selling off. We wait for it to roll back above the first standard deviation Bollinger Band. That's when we check to make sure the last two candles were below the first standard deviation Bollinger Band. We go long, and our stop was 60 pips. So we go long pretty much around, I would say 134.40, let's say. And so our target is 134.90, which we would have been hit over here. And I think I have another example here of picking tops and bottoms using the double Bollinger Bands. So here, Aussie is selling off, selling off, selling off. We wait for it to rally and rise back above the first standard deviation Bollinger Band. And at the time, we check to make sure the other candles are below the Bollinger Band by at least 10 pips, and it is. So we go long And you can see that, it moves quite a bit in our favor, so most definitely hit the profit target. So that's how we look to pick tops and bottoms on using the double Bollinger Bands on a short-term as well as long-term reversal basis. Now, let's look at joining a trend. So we looked at reversals. Now let's look at trends. Trends are rare, but also very popular trading environments because once it happens, trends only occur maybe 30% of the time, but when they happen, they can go for a while. And once it starts to continue, it can continue way beyond reason. So what makes a trend? It's actually quite simple. Higher highs, higher lows, and in an uptrend, you basically want to see higher highs and higher lows. In a downtrend, you want to see lower highs and lower lows. Of course, it's best seen in retrospect because when you're looking at it live, it's obviously much more difficult to interpret. But with trends, the most important thing is that you want to avoid these false starts. You want to capture the true move and not the false starts. And that's why you start with the raw price action. Because in false starts, you can have, like in this case, we're in uptrends. Let's say you think, okay, we've got a top. And it pulls back. It does pull back by a decent amount, but the broader trend is up. And same thing with the downtrend in the pound dollar. So how can you filter this out? Well, I think, the rule of 1% and the power of 1% is probably pretty valuable at this point, where a true breakout is probably best defined as a 1% move. And, you want a very simple way of looking at this is you want a 1% breakout in your favor with a stop of 1% and maybe a 2% target. This is a very simplistic way of looking at it. We'll look at it with more indicators and things like that a bit later on, but it's a simplistic way of looking at filtering false breakouts and focusing on the true breakouts. So here, if let's say you're basically see a little bit of a pullback in dollar yen, rather than just kind of arbitrarily buying, I would wait for it to break out back above the previous high by 1%, go long, 2% target, 1% stop. And here, same story. You see a bit of consolidation, lots of false starts, a bit of pullback. You want to once again look for a 1% breakout from these highs here at above a 1% breakout above 92.42 would be 95.70. So that's where you could use the power of 1% and basically look for a 1%. The point I want to make is that you want to look for a 1% break of a previous low. If you see a 1% break of a previous low, that's when you could potentially have a real move versus a false start. And so, if we look at it without, on a more zoomed in basis, without all of those examples, what you would be doing is you would basically, let's say you have the swing low, 1.0115, and you want to look for a 1% break below the swing low. So like parity with a 2% target of 98. You can also trend trade using multiple time frame analysis. I actually do that quite often from a top-down approach, looking at daily charts, 4-hour charts, and hourly charts. And what you want to see is and what I like to see is a break of multiple significant moving averages. So first you establish the trends using a daily chart. So you want to look for an expansion of moving averages. You want to look for it to trade above or below the 20-day SMA, depending upon which direction you want the trend in. So in this case, we have an uptrend. So we want to look for dollar yen to be trading above the 20-day SMA, but it can be well above it. After that, we look at our 4-hour charts to pinpoint our entry and exits. And what I like to do is I like to add on the 20-day and the 50-day SMA. And I like to look for it in an uptrend. I want to see it rise above the 50 and the 20-day SMA. In a downtrend, I want to see it below the 50, and the 20 SMA. So you can use that as a reference. In this case, let's imagine we're in a downtrend. You want to sell whenever it touches the 20 SMA with a stop at the 50-day SMA. This happens when the trends are strong. And a stop at the 50-day SMA. So this is what you're seeing. And then your target would be 1 times risk, and move your stop to break even when it reaches your target. So, that's what you can do using this chart. And even an uptrend in dollar yen, which is that first example I showed you, you're in an uptrend, you can buy whenever it touches the 20-period SMA in the 4-hour chart with a stop at the 50-period SMA. But what I really love to do is use the Bollinger Bands to help me join new trends. And one technique of doing that is the trends catcher trading strategy. The trend catcher trading strategy uses daily charts. And what you want to do is you want to look for a close below the first standard deviation Bollinger Band in an uptrend. So let's imagine, well, for a short trade, you want to look for a close below the first standard deviation Bollinger Band uptrend. So let's imagine the currency pair is selling off. So you want to look for it to move below the first standard deviation Bollinger Band. So here, in this example, you basically see dollar yen selling off, selling off, selling off. And then it moves, previously we said that if it breaks above the first standard deviation Bollinger Band, then it's time to pick a top and bottom. But when it goes into the first standard deviation Bollinger Band, then what you want to do is you want to basically join the trend, join an existing trend that is in place. So in this example here, you can see that it closes below the first standard deviation Bollinger Band. That's when we want to look at potentially joining the trend. So we check, but before doing that, you want to check and make sure that the past 2 candles is above the first standard deviation Bollinger Band. And in this example here, you'll see where my arrow is. And you'll see that it closes below the first standard deviation Bollinger Band. And you check the last 2 candles. Let me get my little arrow to point it to you. Check the last 2 candles, and you see that it's above the first standard deviation Bollinger Band. That's when you have the parameters for selling. You sell at the close of the candle, which is 5 p.m. New York time, 21 GMT. So in this case, what you're looking to sell is you're basically looking to sell at 108.90. Your stop is at 65 pips, a flat 65 pips. Your target on half of the position is plus 50, and target on the second half of the position is plus 195. So in case it moves so far that it goes plus 195, that's when you want to exit the second half of the position. For the short trade, when the first 50 pips is banked, you move your stop and the rest to break even. It's actually what we do with all of our strategies. We move our stop to break even, and then see if it continues to move in our favor. So here we sold 1.0890, stop is 65 pips at 1.0955. First target is 108.40, 50 pips. And then you exit. So the second position gets exited because of one of 3 factors. Either your break even continues to rebound and your break-even stop is hit, or your plus 195 pip target is reached, or the currency pair closes below the first standard deviation, above the first standard deviation Bollinger Band. So this should actually say above. So So in this example here, we see that euro dollar drops. It drops into the sell zone. We sold. The first target hit pretty easily. The second target hit, shortly thereafter. An uptrend is the reverse. You want to look for a close above the first standard deviation Bollinger Band. So in my arrow, you see that closes above the first standard deviation Bollinger Band. And when it does that, you check to make sure the past two candles is below the first standard deviation Bollinger Band. And that's what you see over here. You see that the past two candles are below the first standard deviation Bollinger Band. When that happens, you buy. So you buy at 109.53. Your target is for half of the position is 50 pips. Target for the second half of the position is 195 pips. And your initial stop is 65 pips. So here you can see in this example that only our first target's reached. Then it reverses and stops us out at break even. So we made 50 pips in the position, which I think is pretty good in of itself. When 50 pips is banked in the first half of the position, move stop on rest to break even. So here our first target was reached. And you exit the trade either when your plus 195 target's reached, break even stop is hit, or the currency pair drops below the first standard deviation Bollinger Band. And you can see, basically that's the only the first target was hit. And then the last way to use the double Bollinger Bands is to use the double Bollinger Bands to enter an existing trend at value. So what you want to do is, what happens if we're in existing trends? Can you join the move? And my answer is yes, you can join the move. And you basically, what you want to do is you basically want to wait for it to retrace to the first standard deviation Bollinger Band. So you want to wait for it to retrace to the first standard deviation Bollinger Band. So let's say we're selling off. Exactly where my arrow is where it retraces, bounces to the first standard deviation Bollinger Band. And that's where you want to sell, joining the existing trend. So you place your limit order sell at the first standard deviation Bollinger Band. So you sell right here. Short at 110.11. Short at 110.11. Your stop is 35 pips above the first standard deviation Bollinger Band. So your stop is 35 pips above the first standard deviation Bollinger Band. Target 1 times risk, and then move your stop on the rest to break even. So in this case, you sell at 110.11, stop 35 pips, target 109.76. And in this case, your first target was reached, and your second target would have been reached because the low here is 108.50. So that's basically how entries and exits are determined. A lot of people just focus on the entry component of the trade, but we actually pay just as much attention to the entries and exits because we always like to give the example. Let's imagine that you're riding on an airplane. Would you rather the pilot get the takeoff right or the landing right? I'm sure 100% of you will say to me, I want the pilot to get both right because if they get anything less than both right, I'm pretty much dead. And so that's the way you want to approach trading, is because we always focus as much on the entries as well as the exits because, they're equally important. So there's one thing you take away from what we've been talking about recently is that you want fundamentals, technicals, and sentiment on your side for every trade as much as possible. So with that, I'd like to open up the floor. Any questions you may have for me today? Marios, I didn't look at the questions when you were posting them, but can you please let me know which strategy you're talking about? If you're talking about the trend catcher, they're on daily charts. And pretty much all the examples I gave you today are on daily charts with the exception of the 4-hour turn trade. No, I'm not going to cover any CCI strategies because we don't really use it. Because we want the candle to close, Cheng. We buy at 5 p.m. because that's when the candle closes. But usually it's some buffer time. I mean, usually it doesn't do anything from 5 to 7 p.m. New York time or 8 p.m. New York time. So you could get in then as well. Any other questions? These are daily charts. The double Bollinger Bands are available on every single trading platform. Then in order to get the double Bollinger Bands, you have to add an extra set of Bollinger Bands. Just add the Bollinger Bands again, no different from if you were adding multiple sets of moving averages. And then change the deviation from 2 to 1. Good questions. Can you move to lower time frames? 4 hours is as low as I'll go. Do you use Bollinger Bands and RSI stochastic together? But I just use Bollinger Bands in of itself. I think there's too much going on if you try to add the other indicators. Any other questions? If there are no additional questions, the stop set is certain pips. For some of them, like Trendcatcher, it's just 65 pips. For other ones, it's above or below the first standard deviation Bollinger Band, using that as our reference. Any other? The 1-1 bands. Yeah, so basically you want to use the what if price moves within the bands? Then you range trade, yes, Cheng. But more like you're picking tops and bottoms. I think it's just used more for informational purposes to let you know that we're in range trading mode right now. What happens when the two moving averages cross? We don't really use that for this one, but if you're looking at the moving averages that cross, then your stop is obviously above the 50, which is usually further away, and usually it's a pretty tight stop, so I think it's worth a try. Good questions. It lets me know that all of you are paying attention and that you're engaged with the session, which is truly my favorite. Any other questions? If not, feel free to ask me the questions later on. I'll be more than happy to answer them for you. And you can email me at contact@bkforex.com. All right, if there's no additional questions, I'd like to thank all of you for joining me today and wishing you all a great day.